Hey, this is Sasha. I want to share with you some insight today about automating your option trades. Is it really a smart thing to do? And should you really think about doing it? I know that these days there's more and more automation going on. And whether we're automating robots to flip hamburgers, to automating Teslas, to driving your vehicles, is it really something that you should do when it comes to your trades? And I think it really comes down to a question of what are you trying to accomplish by automating? Automation does have some great perks. It does make some things a little bit easier, but unfortunately you do have some bad results. So things like Tesla car crash, you look it up, there's a ton of things that make headlines and news regarding this. Now, I think that's kind of like a really big dramatic issue here. It's really sad and disappointing because at the end, somebody's going to blame somebody else, and it's just nonstop blaming because of the death. Death is very extreme. Whereas when we talk about investments, it can still be extreme to the sense of, hey, we're losing our money, we can't go ahead and purchase things, or we might even lose our wealth in retirement. But it's not as extreme as maybe a car crash. Car crash or death is even more dramatic and, sad, unfortunately. Whereas when we look at automating our option trades, it's not as nasty, but it might allow you to be more consistent, you might think, or repeat certain things. But there is a certain complexity that goes with it. And when you really look at it, as you look into trading more and more and you get into some depth behind it, it's not dynamic, unfortunately, and it's not able to tweak things based on different situations. And the same reason why car crashes happen, there's situations that happen in your option trades or just trading in general that you could go ahead and manually see that and just do a little tweak to go ahead and adjust them, right? But if you're not there and you're automating, you might still get into some serious problems when things malfunction. Nothing robotic that I've noticed over the years has been 100% foolproof. That's just the fact of the matter. All we're trying to do is kind of systematize or make things a little bit easier. So could you go ahead and automate, let's say 20% of your account? Yeah, that might work. But as you start really looking at things and you start understanding the way trading works, a lot of it is also about looking at reducing your actual loss. So let's say a trade is losing $1,000, and by manually tweaking it and understanding different trades, you might say, okay, well, I'm going to go ahead and tweak and work that trade. Like, let's say just as something as simple as a covered call, I'm going to go ahead and sell some calls against things. Well, I'll go ahead and make back $100, go ahead and make back 80, make back 70, make back 40. And with time, you might be able to reduce those losses to, let's say, minus $300. So instead of losing 1,000, you might lose 300. And that's something about trading that's a lot different, is if you can minimize the losses, the rest of that can actually be quite good because then the winning trades can actually pan out and work out. But when you're starting to automate things, it can be a little bit, cut and dry. It's like, hey, this is the way I'm taking my profits. This is where I'm taking my loss. Well, what if there's some gray zones and gray areas in between? And that does happen. So I'll show you kind of some of these videos that I am working through on my weekly's options class. And what I want to show you is this trade right here. It started with basically a double calendar setup. So I've got this double calendar here set up on Netflix here, okay? So if you look at it, okay, so we're starting out, there's a little bit of a loss there. And then it ends up turning into kind of a triple calendar because the stock starts moving against me a little bit pretty quickly, okay? And then what I did was peeled off some contracts from some of the other side, maybe the left side, or, took a quick little loss and converted it into maybe a tighter double calendar. So by seeing, hey, that stock's a little extended, I might choose to do something a little different than I would. If it was automating it, it would just do the same thing over and over again, and it might not adapt to the conditions, right? It might not, let's say you set on cruise control. Well, if you go in and you set a car to cruise control, and let's say we're going at 60 miles an hour, but what happens is there's no specific way saying, hey, well, if we are going 60 miles an hour, but there's more bumps in the road at a certain level, I want to slow it down by 5%. Or if the rain starts coming and there's 3 gallons of rain per minute or something like that as you're hitting the car. Well, again, slow down by another 1%. You can't really accommodate that. What you could do is if you're driving it, you could pause on the brakes or hit the brakes a little bit, but you just can't do that when it comes to automating those things, because it's not dynamic enough. It's not quick enough. But when you're doing these things on the trades here, you can do that much more so. So you're able to really get into that a lot better, into the trenches of saying, hey, I'm going to tweak this, I'm going to tweak that, and then make it a little bit work. Here's another example I'll show you. Here's a CCL. This is again from the weeklies class. So it's starting to break out. This was an 11-day trade. So I got a bunch of contracts in there, boom, 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 spreading out the risk, popping in and putting on a lot of contracts. Starts to go against me right here. That's pretty nasty, right? But once you get into this big loss and you see, okay, well, that's a big loss. Well, what if I could go ahead now and start selling against it? And it's not something you can do on an automation that you could say, okay, well, I've got this one now. Well, let me now tweak and work that trade and do something different. Let me show you another one here. How about, let's see if this one is a good one. Here is Zoom. Okay, so we started out with kind of a calendar and double calendar here. So this one's coming in. And we've got kind of a little bit of skewed position because maybe the market's a little bit, still different. Okay, so we're starting to lose on this position. So again, I want to show you the concept behind, hey, when things are not going your way, right? So what I did was sold more and more calls to hedge that off. So that way the losses are smaller. And look, I hedged more of it off and more of it off in order to tweak that position by selling more of these verticals over here against it. And look at that. So it reduces that loss even more so. And that is the whole point, where automation is not able to really think about these things. They would have just probably gotten me out of the position, and let's say I would have lost $3,000. Well, in this case, I might have only lost $1,400. The point to understand here is that, can automations help? Yeah, they can. They can make your life a little simpler. But if you really want it simple, just get yourself some ETFs and just go it in that route and you're good to go. But if you want to actually do some trading, a lot of the trading actually is dynamic. It needs to be fluid, just like water. You adjust, you tweak, you modify, you adapt to conditions. Just like, look, if you're trying to lose weight, you adapt. If you do some weightlifting or you go do some running and you're trying to lose weight, you adapt, you change, you tweak it. If it's not working, you tweak it. You change your diet and you modify the exercises. It's not cut and dry. Even though you do want to repeat things, you're going to be tweaking it. So can automations work? Yeah, they can. And can they make your life easier? Sure, they can. But in those instances where you're trying to go ahead and be a little more dynamic to tweak, those automations have to constantly be tweaked based on market conditions. What if premium becomes more expensive, or premium becomes cheaper, or now the value of that stock is stretched? Would you still do an iron condor? Would you still do an iron condor maybe with some protection? Would you do an unbalanced iron condor? There's a whole different world. There's different types of iron condors. Maybe you'd go, instead of a 30-day iron condor, you'd go 45-day iron condor. And not to mention, you'd spread your risk out. You wouldn't just say, hey, I'm going to automate this thing, because when you really look at a trading portfolio, you got to spread your risk. It's fine to automate things and you got 10, 20 grand. But once you go ahead and do something with more and more capital, or you got to start spreading your positions out. I got a few bucks here, I got a few bucks here, a few bucks here, a few bucks here, boom, boom, boom. It's all spread out all over the place. So that way, not one position's got me in trouble. It's not that I'm just repeating a 20 grand trade always in Disney, another one. No, you're spreading it out based on what you see opportunities in different zones. Again, could you take 20 grand and automate it? Yeah, you could. But if other than that, the more capital that you have, the more it needs to be spread out. So if you got a little bit of capital here, all over the place, now you're really diversified and spreading it out. Different strategies, different place. It makes a lot more sense. Anyway, I hope that helps, gives you some insight as for automating things. Truly appreciate you joining me. And, if you have any questions, feel free to reach out, and I hope to see you in one of my live classes, or check out the class here that we recently launched when it comes to trading weeklies. So thanks again, and I will see you next time.